Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Welcome, everybody, to the Norris Group Real Estate Podcast. Today's guest is Andrew Falde, SVP of Capital Markets for DBL Capital. With a background spanning Wall Street, private funds, and institutional real estate groups, he's brokered over $300 million in real estate transactions and spent his career structuring deals, raising capital, and building systems that create long-term value. Andrew brings a unique blend of strategic thinking and hands-on experience to every conversation, and today, you're going to hear exactly how he approaches the game. Let's welcome Andrew. Thank you, Andrew, for joining us. It's good to have you on today.
Glad to be here. Thanks, Joey.
All right. So we thought we just, we get a lot of questions about DBL Capital. We send out Craig's Corner every week, and we're getting some good responses and some good engagements. But, I think people still have this idea that it's something that maybe it's not really. So we thought we'd have you on today to just kind of go over what DBL Capital is, why the fund was created, and, what the plans are and what the future is for DBL Capital. So let's just get right into it.
Awesome.
Usually we do a whole lot of, hey, let's learn about our guests. And it was kind of funny. Last week we got a little feedback like, hey, a little less on the guests and more of like,
why get to the meat. That's right.
Why they're on the show,
Let's do it first, right? Yeah.
Yes, absolutely. So can you tell us why the fund was actually even launched?
Yeah. So I guess there's two ways to talk about the why, the big why behind the fund. So one is like, what is the fund doing? And then why is it the way it is? So what the fund is doing is affordable home construction in parts of America. We specifically targeted Florida right now, but it's really about targeting those places where affordability is becoming a crisis, where home ownership is becoming very difficult to achieve, where a lot of demand is for more expensive homes and has been that way for many years and even historically, and really going into those target markets and making housing affordable to own and rent, primarily for ownership, but also rentals will be in there. And you say, well, you could do that as one-off deals or syndications and all that. So you say, well, that's the purpose behind the fund. So why a fund? Why not syndications? Why not just say you can be the investor and the sister company, Douglas Brook Homes, can be the builder? So why is there a whole fund structure around it? And that's for accessibility. So accessibility and efficiency. So efficiency creates more value, more profit, more opportunity, faster builds, faster use of capital. So the old way that worked very well, but it was limited to who could be in it. The old way, which built well over $100 million of affordable homes throughout the target markets, was that an individual investor had to buy, fund, or sign the debt for, so either fund out of cash or get the loans for 10 homes at a time in order for there to be enough efficiency for the builder, for the manager, that's Craig, to produce enough value for that investor. Otherwise, if you come in and you just say, hey, build me one house that I can flip, I want to build a house and I want to sell it for a profit. Well, to deal with one at a time, you're paying retail. You have to pay full price, just like the end user. What is the value you're creating there? So you have to buy in bulk. And so that limits how many people can do that. 10 homes, it could be $3 million, $4 million in total value. So you either have to sign that much debt or contribute that much cash, or a combination of the two. Then besides that, it was, all right, well, you decided you wanted to do those 10 homes. And now the process just starts the day you sign the contract. So that means, okay, well, you want to do it. Great. Now we'll start looking for land. Now we'll start the entire process. And so you have this build-up period of lag, or as you'll see in a future video from Craig, we call the dead zone, where the capital is working or you're working, but there's nothing being earned. We're still in the waiting game. Well, at this point now with a fund, somebody can tap into and they can contribute a much smaller amount. They get the wholesale access to the fund, and there's already a pipeline of homes under construction, near completion, lots in contract, homes in permitting, and you join immediately as a fractional owner of the entire pipeline, rather than saying, hey, I need to put up 10 times as much capital or debt and just start at the beginning. So that's the reason for the fund being formed, to pass along those economics to investors at a much lower risk and at a much faster cycling of capital.
Can you describe the fund to me like I was in third grade?
I love that. Yeah, just describing like a third grade, which I have a lot of experience with because I have 3 kids under 12 and under right now. And one of them just ended third grade and one was in third grade a few years ago. So I have a lot of experience saying, well, what does that mean? How does that work? What are you doing? They look at me writing code, or what are you doing? Like, okay. So yes, I'm familiar with that concept. I think it's valuable for all of us, to really like what's going on here. So the fund as to a third grader, is that what you're saying, right? Exactly.
Yes.
The fund. I would take that third grader and walk them into any old neighborhood and then point at houses and say, see that house, or you see the house you live in? Say, that would be a lot of work to build that, right? Like if it didn't exist, it was just land there. There'd be a lot of time, a lot of people. There's probably 50 or 100 different people that will work on that house. You have the people in charge of buying the land, person decorating it, designing it, and then you have to pay for it. And then you have to go borrow the money for it. You say, like, all of this has to happen in order to make a house exist. Well, the fund is a way to help people not have to go through and figure out all of that. They can just put their money into a fund, which is a group of investors, a group of people putting their money together, and that pays for all of these houses to be built. And then that will give the opportunity for the person, and then it can be done more affordably because it's done as a professional organization. And then people can buy and live in these homes because there's more of these homes that are at prices they can afford for their family. So I think that would be the simplest way to put it.
Is it just like you just talked about building houses? What else is the fund going to do? Is there more that it's going to do?
Yeah. So building is the core strategy, because as the fund is co-owned, the master organization, DBL Unlimited, it also owns the home builder, manages the fund, and the mortgage company. So there's the most profit margin in producing a new home. So that's why it's the core strategy, and will always be a big driver to it. And then the other will be distressed or discounted acquisitions. So not paying retail, not going to MLS, not just taking the first thing off at a standard cap rate, but really going in and finding where can value be added. And the one way we can force value to be added is through construction, building something. Because you can just say, this product is needed, it can be put here, and then make it happen. All the others are opportunistic, either based on market conditions or individual projects that are distressed or in trouble.
Okay, so we just went from third grade to now we're going to go to over my head.
Yeah.
So is the fund SEC regulated? And what does that mean for investors?
Yes, so it's regulated, SEC regulated. And that's important to know. Like, a lot of people will say, oh, we're regulated. Everyone's regulated. This podcast is regulated by the FTC. Like, in some way, everyone has regulations they're under, but the strictest ones that you can find for any type of investment opportunity is SEC, Securities and Exchange Commission, to have oversight. So this is a Reg D fund. So it's private placement. It's for accredited investors. And that's very important because small syndications, small opportunities don't have as much oversight. And the reason for that is there would be too much to monitor, too much to control. And the government hasn't said this outright, but the way I interpret it and all the rules, as far as you could go out and put a deal together with 15 family and friends, $10 million, $20 million deal, and just fly right under the radar, because they say, well, if as long as you don't hurt a lot of people, and you don't hurt people more than once, like we can't oversee every little deal that's happening. But when you go and put yourself out to the public and advertise to be allowed to take on the general public's capital, you can hurt a lot of people. And so because we have exposure, and because we're saying we're going out and we're offering this to many people publicly, that has the strict oversight of the SEC, especially the way that it's structured here with the fund.
And so even though there's explicit risk, and there's always disclaimers, it does offer some protection for the investors, right?
Mm-hmm. Yep. Just every time I have a meeting with Craig and we're going through numbers and things like that, he'll, in a 20-minute conversation, he'll stop me 5 times and say, be careful, we can't say that. Be careful, we can't say that. Just to make sure we can't overpromise, we can't overstate, we have to be conservative. Ultimately, we just have to let the performance speak for itself, and we can't, overpromise or overstate what's possible.
So where does DBL Capital invest now, and how is that going to change in the future? So
right now it's affordable. The lowest price point that we can build that's attractive to small families or individuals in the Southwest Florida market. That's one where affordability is non-existent. Most people are stuck renting right now. As interest rates have gone up, then their price point has come down even more than it had. Prices have gone up since 2020, accelerated very rapidly. It's gone out of their range. Prices are down a little bit right now because of interest rates, because of just the market cycle, but we're still above where we had been 4 years ago. So we are in a rising market with a little dip right now, a little bit higher interest rates. Some would say a lot higher, but really just kind of more toward historic norms, really.
Right where it's supposed to be.
Yeah, exactly. It's hard to complain. It's just you complain if you didn't get it before, or you can't get it again.
Well, you think about it, it's almost a whole generation of people who are going into home ownership that have never seen the sevens. But, you talk to anybody over 50, they're going to be like, what are you talking about? Like, that's right where it's supposed to be.
I've heard of people saying, my first mortgage was 18%.
Yeah.
Like, well, I guess that's why your home was $80,000 too.
Yeah. Yes.
Yeah.
How is DBL Capital going to identify the new markets, and when will that happen?
Okay. Yeah. So it's wherever the profit margin can be found without depending on appreciation, and where there can be a solid infrastructure put in. So like anyone with construction experience can go to another market, but do you have a team in place? Do you have the disposition broker in place? Do you have the acquisition broker in place, the one who finds the land professionally, knows all the problems there and avoids those problems, whether it's, environmental issues or height issues and needing more fill, these types of things. So wherever you have to have expertise. Now, Craig's built in many different markets, different states, so he does know these things, but this is the market we know. This is the market that's been very attractive for growth for over 20 years, and has been through big spikes and those corrections as well. But that's volatility. It's just like any tech stock or any type of fast growth asset. Think Bitcoin, think anything where it didn't exist before and there's something new happen, you're going to get volatility. So there's volatility in this market, but that volatility continues to be overcome by demand. So the demand keeps coming in, and at that affordable price. And if you just take an aerial view over all these markets and submarkets that we're in, there's so much green space still left. There's so many empty lots, streets that you just look down on and see, only 30-40% of the street has houses on it. And this is the affordable area to live. It's very nice, good weather, close to a lot of employment, close to major airport, university, all these things that you need, that there's really just a lot of opportunity here left. I think the first move outside of this market will be acquisitions rather than construction. and then moving into maybe Central Florida. This is my take. I mean, Craig and I have talked a little bit about it, but my take is the Central Florida market. Just it's astounding as you drive through. You just see trees, orange grove, just nothing, and then you see a Lennar community being built, like just a brand new one under construction, land being cleared. Like, oh, okay. So the migration to the center of the state is happening, and that brings direct access to Disney World if you're into that. It gives you direct access to either coast. So you have a lot of opportunity there in either direction. It gets you a little bit higher, and people like that because it's for any kind of flooding concerns. Also the weather, if you're central, kind of a little bit mid-central, a little bit north, the weather's a little bit cooler. It's 5 or 10 degrees cooler a lot of times in that area. So it's very attractive, and a lot of people are saying, hey, you know what? I'm from Indiana. Hey, I'm from Ohio. I'm from Illinois. We didn't have a beach anywhere near us. I just don't want to be cold anymore. I don't need to be 15 minutes from the beach. I'm more than happy to be an hour and a half from the beach and an hour closer to Orlando and all these different things, and still in a place that's not overbuilt and just feels everything's new. So there's just tons. Just look up any aerial map on Google Maps, Google aerial images, all that, and you're just going to see this wide open territories being built. One's called Babcock Ranch. Is being developed. A whole new city's being built. And when it was first started, they're like, who wants to live out there? Well, that's proven. There's a lot of people. A lot of people are saying, more than happy to not live. I've lived in Florida my whole life. I don't like the beach. And I'm like, I get it. I don't need to be anywhere near. I don't need a boat. There's rivers if I really cared. So there's so much opportunity there.
Part of your job, correct me if I'm wrong, is being really involved with capital raise. What is the hardest part of the initial capital raise? Because once these things get into the tens and 20 million range, it's like people can't wait to throw money in there, right? But what's the hardest part of getting this off the ground?
Yeah, it's kind of, I don't know if you've ever seen the illustration, like the physical illustration where the small domino hits the bigger domino until you can, like, theoretically you could knock over like the Statue of Liberty, starting with a little domino. And that's the same thing with capital, where in any kind of investment at an early stage, you have the angel investors, the round A investors, and then it finally goes to mainstream where people just start doing like direct deposits on a monthly basis, to like add to the account. And so we're at that because this fund is new, and there will be more funds. There will always be a fund release that says, hey, this fund is just for land acquisition and development prior to the housing fund building on it. So there'll be a new fund for that. It'll be new. So the reality is you have to look at the fund manager. You have to look at the team and say, are they new to this? Well, that's not even close. You have multi-decade experience. You have the exact same team and infrastructure and construction license. All that has been going on for well over $100 million in just the last 5 or 10 years. And so that is not new. So it's just instead of like we talked at the beginning, instead of taking one investor or one small group and doing 10 houses here, then another person or group do another 10 houses here, we're saying, hey, you can not take multi-7-figure risk, capital or debt, and you can do that with 6 figures of capital and debt, have the same economics, maybe better, depending on how you slice the debt component, because you're not signing for the debt anymore. So the economics are still just as attractive, and the speed of returns is faster. So the long and short of it is usually it's that after you see that first year of like delivered statements, and then that's when those who have been on the sidelines start to kick in more, feel a little bit less like the angel, a little bit less like, the early adopter. And it's like, all right, here's our 1-year quarterly statements. Here's our annual distribution was done. Here are the houses that were completed. So that's that first year. And we're about 8 months into that, I think, right? Maybe 10 months, because we have part of last year and this year going on. So I think when we're completed with that year, it's going to become a little bit more of less of an uphill battle.
Liquidity is important for a fund. What's the targeted liquidity for the fund, and where is it at right now?
The target, I believe, is 30%. So there's liquidity, and then there's also not having aggregate leverage not over 70%. But our aggregate leverage level is more conservative, and our liquidity level is more conservative than you normally see in a fund, just because we want to be positioned for long-term generational operating, not just one opportunity, not just say, hey, we're just going into this. What's the point of having the cash on the side? What's the point of having that excess margin in there to work with if it's just one syndicate or just one opportunity? We just need a little breathing room in there. So we're more positioned for, hey, we're going to have dry powder. So if land prices are down like they are, we can jump in and grab a bunch of lots at half price with people who say, I have to sell now. It was 40 last year, but it's 25 right now. Fine, I'll sell it or less. So that's what that is really for, safety and opportunity for the fund to do what it needs to do.
Can you tell our listeners, what does waterfall distribution mean, and then what the actual waterfall distribution of DBL Capital is?
Got it. Yeah, so waterfall means that it's not just at the end of the year, we just slice everything up and send it out. There's actually, because you don't know what the return will be, if the return is going to be 8 or it's going to be 28, we just don't know. And that's market conditions, operating, all these different things. How much capital came in, when it came in, and all these different factors. So what we do is we have the investors, the cash, the capital paid first. So that's called the pref, or preference paid payment. So the pref is the 8% amount that goes to the investor. And then from there, and it's all spelled out in the docs in exact form and exactly what order and what has to be paid in what order. But the most important thing is the capital investor is paid first, then a asset management fee, then the splits start. So after the asset management fee is paid, which is after the pref, then we have the 80-20 split, 80 to the investor, 20 to the manager. And that takes it all the way up until 12% return has been calculated and distributed. And then above 12% is 50-50. So the 12% is called the target return, which can be misleading. It sounds like, oh, you try to make 12%, and that's the end of the story. And I don't even get all of that. I have to split some of it. So the reality is that's the target before we get excited. That's the target to say, we're trying to get up and through that. And then based on market conditions and efficiencies and speed of construction, all these other factors, when the cash was in, when the capital came in, all those other factors, now we're playing the real game, which is we're splitting 50-50 above that. So that's where we're really trying to get is north of 12% and take that 50-50 split above that.
Okay, everyone, that's going to do it for this week's episode. Please be sure to tune in next week for part 2.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.